Chapter 1. Money is not just a tool. It is a mirror. It reflects your discipline, your fears, your habits, your patience, and your understanding of reality. Most people think financial success is about earning more. That is a shallow interpretation. Earning is only one variable in a much larger system. True financial control is about managing behavior under uncertainty. It is about making decisions when emotions are loud and logic is quiet. The majority of individuals remain financially stagnant, not because they lack intelligence, but because they lack a structured philosophy. They react instead of plan. They consume instead of allocate. They chase instead of build. And this creates a cycle that quietly drains their future while giving them the illusion of progress. If you want to master finance, you must first understand one principle with absolute clarity. Wealth is not created by income alone. Wealth is created by the gap between what you earn and what you keep, multiplied by how intelligently you deploy it over time. This is where most people fail. They increase income, but their lifestyle expands faster than their financial awareness. The result is predictable: more money, same stress, no freedom. Financial management begins with awareness. You cannot control what you do not measure. This is not theory. This is operational reality. Every rupee, every dollar, every transaction carries data. That data tells a story about your priorities. When you begin tracking your financial behavior without excuses, patterns emerge. Some of those patterns will be uncomfortable. That discomfort is not a problem. It is the starting point of transformation. Discipline in finance is not about restriction. It is about intentionality. There is a difference between being unable to spend and choosing not to spend. The first is limitation. The second is power. When you consciously decide where your money goes, you are no longer reacting to life. You are designing it. Most individuals underestimate the impact of small financial decisions. A daily unnecessary expense seems insignificant in isolation, but compounded over years, it becomes a silent destroyer of wealth. This is the mathematics of accumulation working against you. The same principle can work in your favor if you reverse the direction. Small, consistent, intelligent decisions build financial strength that appears invisible at first and undeniable later. One of the biggest misconceptions in finance is the belief that complexity equals effectiveness. People assume they need sophisticated strategies, advanced tools, or insider knowledge. In reality, the fundamentals are simple. Spend less than you earn. Save consistently. Invest intelligently. Avoid unnecessary debt. Maintain liquidity. The difficulty is not in understanding these principles. The difficulty is in executing them consistently over time. Execution requires a system. Without a system, motivation fades. Emotions interfere. External influences take control. A financial system is not just a budget. It is a structured framework that governs how you earn, spend, save, and invest. It removes randomness from your financial life and replaces it with clarity. Your first system is allocation. Every unit of income must have a predefined role before it arrives. If you wait until money is in your account to decide what to do with it, you have already lost control. Allocation creates boundaries. It ensures that essentials are covered, savings are protected, and investments are prioritized. There are three primary categories that define financial structure: survival, stability, and growth. Survival includes your basic living expenses. Stability includes emergency funds and insurance. Growth includes investments and income-generating assets. Most people operate only in survival. Some reach stability. Very few focus aggressively on growth. That is why financial independence is rare. Debt is one of the most misunderstood elements of finance. It is neither inherently good nor inherently bad. It is a tool. Like any tool, its impact depends on how it is used. Productive debt can accelerate growth when it is used to acquire assets that generate income or appreciate over time. Destructive debt, on the other hand, finances consumption and depreciating liabilities. The problem is that most people cannot distinguish between the two. Emotional spending is another critical factor. Purchases are rarely driven purely by need. They are influenced by status, comparison, impulse, and temporary satisfaction. The market is designed to exploit this. Every advertisement is engineered to bypass logic and trigger desire. If you do not develop awareness, you will become a predictable participant in this system. Financial intelligence requires you to pause between impulse and action. That pause is where control exists. It allows you to evaluate whether a decision aligns with your long-term objectives or merely satisfies a short-term emotion. Time is the most powerful variable in finance, not income. Not luck. Time. The earlier you start managing your money effectively, the more leverage you gain from compounding. Compounding is not just a mathematical concept. It is a force multiplier. It rewards patience and punishes delay. Every year you postpone disciplined financial behavior, you increase the cost of your future. Risk is another dimension that must be understood with precision. Avoiding risk completely is not a strategy. It is a guarantee of stagnation. Taking uncontrolled risk is equally dangerous. The objective is not to eliminate risk, but to manage it intelligently. This requires diversification, research, and a clear understanding of your risk tolerance. Financial independence is not about luxury. It is about control. It is the ability to make decisions without being constrained by immediate financial pressure. It is the freedom to choose your work, your time, and your priorities. This level of control is achieved through consistent, disciplined financial management over an extended period. One of the most important shifts you must make is moving from a consumer mindset to an investor mindset. Consumers focus on spending. Investors focus on allocation. Consumers ask how much something costs. Investors ask what it returns. This shift changes everything. It transforms how you view money, opportunities, and time. Income diversification is another critical element. Relying on a single source of income is inherently risky. Economic conditions change. Industries evolve. Jobs disappear. When you build multiple income streams, you reduce dependency and increase resilience. This does not happen overnight. It is built gradually through skill development, strategic investments, and calculated risks. Consistency is more important than intensity. Many people start strong. They create budgets, set goals, and feel motivated. But they lack sustainability. Financial success is not achieved through short bursts of discipline. It is achieved through long-term consistency. Small, repeated actions create large outcomes. Your environment also plays a significant role. If you are surrounded by individuals who normalize poor financial behavior, it becomes difficult to maintain discipline. Social influence is powerful. It shapes your expectations and decisions. You must either change your environment or become strong enough to operate independently within it. Education is essential, but it must be practical. Reading about finance without applying it creates an illusion of progress. Real learning happens through implementation. When you make decisions, experience consequences, and adjust your strategy, you develop true financial competence. Tracking progress is necessary for maintaining momentum. When you see measurable improvement, it reinforces positive behavior. This could be an increase in savings, reduction in debt, or growth in investments. These metrics provide feedback. They tell you whether your system is working or needs adjustment. Patience is non-negotiable. There is no shortcut to sustainable financial success. Any strategy that promises rapid wealth with minimal effort is either incomplete or deceptive. Real wealth is built slowly, deliberately, and intelligently. The final principle in this chapter is ownership. You are responsible for your financial reality. External factors exist, but they do not eliminate your ability to make better decisions. When you take ownership, you stop blaming circumstances and start building solutions. This is where your journey begins, not with a complex strategy, but with a clear understanding that financial management is a discipline, not an event. It is a continuous process that requires awareness, control, and execution. In the next chapter, we will move deeper into the architecture of income, breaking down how to increase earning potential, leverage skills, and position yourself strategically in a competitive economic environment. It is a reflection of your value in the marketplace. If you want to control your financial future, you must first understand how income is created, multiplied, and protected. Most people make a critical mistake. They treat income as something fixed, something external, something they have limited control over. That belief alone keeps them stuck for years. Your income is directly tied to three variables: your skills, your positioning, and your leverage. If even one of these is weak, your earning potential remains limited. If all three are optimized, your income begins to scale in ways most people never experience. Pause here for a second and think about this. Nobody is coming to increase your income for you. There is no automatic upgrade. The system rewards those who deliberately increase their value. If you're serious about mastering finance and building real income power, make sure you stay with this till the end, because most people miss what comes next. And if you're someone who wants complete control over money, not confusion, hit subscribe now, because this is where your transformation actually begins. Now understand this clearly. Skills are the foundation of income, not degrees, not titles. Skills. The market does not pay you for effort. It pays you for results. The more valuable and rare your skill set, the higher your earning potential. This is why two people working the same number of hours can have completely different incomes. There are two types of skills you must develop: high-income skills and scalable skills. High-income skills allow you to earn more per unit of time. Scalable skills allow you to earn without directly trading time. When you combine both, you create a powerful income engine. Most people remain trapped because they only focus on active income. They work, they get paid, and the cycle repeats. The moment they stop working, the income stops. This is not stability. This is dependency. To break this cycle, you must start building income streams that are not entirely dependent on your time. This includes investments, digital assets, businesses, or any system that continues generating value even when you are not actively involved. But here's the truth most people avoid. Building additional income streams requires effort upfront with delayed rewards. And this is where the majority quit. They want immediate results. They want fast money. They do not have the patience to build systems. If you stay patient while others chase shortcuts, you automatically gain an advantage. Now let's talk about positioning. You can have valuable skills, but if you are positioned poorly, your income will not reflect your true worth. Positioning is about where and how you apply your skills. It is about choosing the right market, the right audience, and the right environment. For example, a highly skilled professional in a low-paying market will always struggle compared to an average skilled individual in a high-value market. The difference is not just skill, it is positioning. This is why understanding global opportunities is critical. Your physical location does not have to limit your income anymore. The digital economy has removed many barriers. You can work with international clients, build global audiences, and access higher-paying markets if you position yourself correctly. But positioning requires awareness. You must study where demand exists. You must identify gaps. You must align your skills with opportunities that have real economic value. Let me make this very clear. Hard work without strategic positioning leads to frustration. Smart positioning with consistent effort leads to exponential growth. Now comes leverage. Leverage is what separates high earners from average earners. It allows you to multiply output without increasing effort proportionally. There are different forms of leverage. Time leverage through systems and automation. Financial leverage through investments. Social leverage through networks and audiences. The most powerful form today is digital leverage. One piece of content can reach millions. One product can be sold repeatedly. One system can generate income continuously. This is how modern wealth is built. If you are not using leverage, you are limiting your potential without realizing it. And here is something important. At this point, many people feel overwhelmed because they realize how much they are not doing. That is normal. But awareness is not a weakness. It is the beginning of control. If this is opening your mind and giving you clarity, take 1 second right now and subscribe. Because the next part is where we connect income with real financial growth, something most people never fully understand. Now, let's go deeper. Increasing income is not just about working harder. It is about working with precision. You must constantly evaluate your current income strategy. Ask yourself, is this scalable? Is this sustainable? Is this aligned with future opportunities? If the answer is no, you need to adapt. Adaptation is not optional in finance. Markets evolve. Skills become outdated. Opportunities shift. Those who fail to adapt become irrelevant. Those who evolve stay ahead. This is why continuous learning is essential. But again, learning without application is useless. You must convert knowledge into action. Another critical factor is negotiation. Most people accept what they are offered without question. This is a mistake. Whether you are employed or self-employed, your ability to negotiate directly impacts your income. Negotiation is not about confrontation. It is about clarity and confidence in your value. When you understand your worth, you communicate differently. You set boundaries. You demand better outcomes, and the market responds. Now let's address a dangerous habit: lifestyle inflation. As income increases, expenses increase. This is one of the biggest traps. People upgrade their lifestyle faster than they build their assets. The result is a higher income with no real financial progress. If you want to build wealth, you must control this. Increase your income, but do not increase your expenses at the same rate. Create a gap. That gap is where wealth is built. This is the difference between looking rich and becoming rich. Looking rich is temporary. Being rich is structural. Now think about this. Every increase in income gives you two choices: consume more or invest more. One leads to temporary satisfaction. The other leads to long-term freedom. Your decisions today determine your position tomorrow. And here is where most people lose focus. They underestimate consistency. They try something for a short time, see slow results, and quit. But income growth, especially scalable income, takes time. There is a lag between effort and reward. Those who understand this stay consistent. Those who don't keep restarting. If you stay consistent while others quit, you win by default. Let me bring everything together. To increase income, you must develop valuable skills, position yourself in high-opportunity markets, and use leverage to multiply results. At the same time, you must control expenses, avoid lifestyle inflation, and maintain consistency. This is not theory. This is a framework. And frameworks create results. Before we move to the next chapter, understand this one thing deeply. Income alone will not make you wealthy. What you do with that income will. And that is exactly where we are heading next. In Chapter 3, we will break down the science of money allocation, how to control your cash flow, and how to build a system where every rupee you earn starts working for you. If you've made it this far, you are already ahead of most people. Stay consistent, stay focused, and continue. Chapter 3. Money without structure disappears. It does not matter how much you earn. If your cash flow is unorganized, your financial life will always feel unstable. This is where most people struggle, not because they lack income, but because they lack control over how that income moves. Cash flow is the bloodstream of your financial system. If it is chaotic, everything else suffers. If it is structured, everything becomes predictable, stable, and scalable. Right now, most people operate in a reactive financial state. Money comes in, expenses happen, and whatever remains is either saved randomly or spent unconsciously. This is not a system. This is drift, and drift always leads to inefficiency. The first step in mastering financial management is to eliminate randomness. Every unit of money must have a purpose before it is spent. Not after, before. This single shift separates financially disciplined individuals from everyone else. Think about this carefully. If you receive your income and then decide what to do with it, your decisions will be influenced by emotions, impulses, and immediate desires. But if you decide in advance where your money will go, you remove emotional interference. That is control. Now, let's build a system that works in real life, not just on paper. Your income should be divided into clear allocation zones, not complicated categories, but powerful, functional segments that guide your decisions. The first zone is survival. This includes your essential living expenses. Food, housing, utilities, transportation. These are non-negotiable. But here is where precision matters. Essentials must remain efficient, not excessive, not inflated. Many people hide luxury inside needs and destroy their financial structure without realizing it. The second zone is stability. This is your protection layer. Emergency funds, basic insurance, and financial buffers. This is what keeps you safe when life becomes unpredictable, and it will become unpredictable. Medical emergencies, job disruptions, unexpected expenses. Without stability, one event can collapse years of progress. Most people ignore this zone until it is too late. The third zone is growth. This is where wealth is created. Investments, business building, skill development. This is the only zone that multiplies your money. Survival maintains life. Stability protects it. Growth expands it. If you are not consistently allocating money into growth, you are not building wealth. You are only maintaining existence. Now here is the critical insight. Your financial success depends on how you balance these three zones. Too much focus on survival leads to stagnation. Ignoring stability leads to vulnerability. Neglecting growth leads to long-term failure. You need all three working together. At this point, you might be thinking, how do I actually implement this in a practical way? Here is where most people make another mistake. They overcomplicate the system. They create detailed budgets they cannot maintain. They track everything for a few days and then stop. The solution is simplicity with consistency. Start with a fixed allocation model. For example, assign a percentage of your income to each zone. The exact numbers can vary depending on your situation, but the principle remains constant. A common structure could be something like this: 50% for survival, 20% for stability, 30% for growth. This is not a rigid rule. It is a starting framework. As your income increases, your goal should be to reduce the percentage spent on survival and increase the percentage allocated to growth. That is how you accelerate wealth creation. Now understand this. Discipline in allocation is more important than the amount itself. Even if your income is small, consistent allocation builds the habit. And habits create outcomes. If this system is making sense and giving you clarity, this is exactly the kind of knowledge that transforms financial lives. Make sure you are subscribed because the deeper strategies we are about to cover will connect everything into a complete wealth-building system. Now let's go deeper into execution. The best way to enforce allocation is through separation. Do not keep all your money in one place. That creates confusion and increases the chance of overspending. Instead, divide your income into different accounts or digital wallets based on your zones. One for expenses, one for savings and emergency funds, one for investments. This creates physical boundaries, and boundaries create discipline. When your expense account runs low, it signals you to stop spending. When your investment account grows, it motivates you to continue allocating. This is behavioral finance in action. Now let's talk about one of the most dangerous leaks in your financial system: untracked spending. Small, frequent, unrecorded expenses silently destroy your allocation system. You may not notice them individually, but collectively, they have a significant impact. Tracking is not about restriction. It is about awareness. When you track your spending, you expose inefficiencies. You identify patterns. You see where your money is actually going, not where you think it is going. And once you see the truth, you can change it. Another important concept is timing. When you receive your income, your allocations should happen immediately. Not later, not after spending. Immediately. This is called paying yourself first. Your savings and investments must be treated as a priority, not an afterthought. If you wait until the end of the month to save, there will be nothing left. But if you allocate at the beginning, you force yourself to live within the remaining amount. That is discipline by design. Now let's address a psychological barrier. Many people feel restricted when they start managing money. They feel like they are losing freedom. In reality, the opposite is true. Uncontrolled spending creates temporary pleasure but long-term stress. Controlled allocation creates short-term discipline but long-term freedom. You are not restricting yourself. You are repositioning yourself. Here is another key insight. Your allocation system must evolve as your life changes. If your income increases, adjust your percentages. If your responsibilities change, adapt your structure. If your goals shift, realign your priorities. A static system in a dynamic life will fail. Flexibility with discipline is the key. Now consider this scenario. Two individuals earn the same income. One spends randomly and saves inconsistently. The other follows a strict allocation system, invests regularly, and tracks spending. After 5 years, their financial positions will be completely different. Not because of income, because of behavior. Behavior is the real driver of financial outcomes, and behavior is controlled through systems. At this point, you should realize something important. Financial stress is rarely caused by low income alone. It is usually caused by lack of structure. When you know exactly where your money is going, uncertainty disappears. And when uncertainty disappears, stress reduces. Clarity creates confidence. Before we move forward, take a moment to reflect. Are you controlling your money, or is your money controlling you? If your answer is not what you want it to be, that is fine, because now you have a system to change it. And if you are still here, still focused, still learning, then you are already operating at a level most people never reach. Stay consistent and continue. In the next chapter, we will go deeper into saving and emergency funds, how to build a financial safety net that protects you from uncertainty and allows you to take calculated risks without fear. It is built long before the crisis arrives. Most people only start thinking about saving when something goes wrong, and by that time, the damage is already done. Financial stability is not about reacting to emergencies. It is about preparing for them with precision and discipline. Saving money is often misunderstood as a passive activity. People think it is simply about putting aside whatever remains at the end of the month. That approach fails consistently because it is based on leftovers, and leftovers are unreliable. True saving is intentional. It is structured. It is prioritized before spending, not after. The purpose of saving is not just accumulation. It is protection. It creates a buffer between you and uncertainty. Without this buffer, every unexpected event becomes a financial shock. With it, you remain stable, controlled, and capable of making rational decisions under pressure. Most individuals operate without a proper financial safety net. They are one emergency away from disruption. This is not because they are careless, but because they underestimate the importance of liquidity. They invest too early, spend too freely, or simply delay saving altogether. Liquidity is power. It gives you options. It gives you time. It allows you to respond instead of react. Now understand this clearly. Saving is not about how much you earn. It is about how consistently you allocate. A person with moderate income and strong saving discipline will always be more financially secure than a high earner with poor habits. Consistency builds reserves. Reserves build confidence. Confidence allows better decisions. At this point, you need to shift your mindset. Saving is not a burden. It is a strategic move. If this is changing how you think about money, stay focused, because what comes next will define how secure your future really is. And if you want complete mastery over your financial life, make sure you are subscribed, because each chapter is building a system most people never learn. Now let's move into structure. An effective saving system is built around one core component: the emergency fund. This is your first line of defense. It is not an investment. It is not for growth. It is for protection. Your emergency fund must be easily accessible, not locked away in assets that fluctuate or require time to liquidate. This is critical. In a real emergency, speed matters. The size of your emergency fund depends on your financial responsibilities and risk exposure. A general benchmark is to maintain 3 to 6 months of essential living expenses. If your income is unstable or your responsibilities are high, you may need more. This is not excessive. This is preparation. Now consider this. Without an emergency fund, any unexpected expense forces you into one of two actions. Either you take on debt or you liquidate your investments prematurely. Both options damage your financial progress. But with an emergency fund, you absorb the shock without disruption. That is the difference between fragile and resilient financial systems. Building this fund requires discipline. It will not happen overnight. You must allocate consistently, even if the amount is small. What matters is continuity. Many people make the mistake of stopping once they reach a certain amount. They feel comfortable and shift their focus entirely to spending or investing. This is dangerous. Your emergency fund must be maintained. If you use it, you must rebuild it. If your expenses increase, you must adjust it. It is not a one-time task. It is an ongoing responsibility. Now, let's address a common psychological challenge. Delayed gratification. Saving requires you to sacrifice immediate pleasure for future security. This is difficult in a world that constantly encourages consumption. Every platform, every advertisement, every trend pushes you to spend now and think later. You must resist this, not by force, but by understanding. Every time you choose to save instead of spend, you are strengthening your future position. You are increasing your resilience. You are gaining control, and control is more valuable than temporary satisfaction. Here is a powerful shift. Instead of viewing saving as losing money, view it as paying your future self. Your future self will face challenges, opportunities, and decisions that require resources. The money you save today becomes the support system for that version of you. Now let's go deeper into optimization. Once your emergency fund is in place, your saving strategy must evolve. You must begin separating short-term savings from long-term capital. Short-term savings are for planned expenses. These include things like travel, education, or major purchases. This prevents you from disrupting your investments or emergency fund. Long-term capital, on the other hand, transitions into investments. This is where saving transforms into wealth creation. But here is where discipline is tested. Many people accumulate savings and then misuse them. They dip into their reserves for non-essential expenses. They blur the line between saving and spending. This destroys the entire system. You must create strict boundaries. Emergency funds are only for emergencies. Short-term savings are only for planned goals. Investments are not to be touched unless strategically necessary. This clarity eliminates confusion. Now, let's talk about one of the most underestimated benefits of saving: peace of mind. Financial stress is one of the most common sources of anxiety. It affects decision-making, productivity, and overall well-being. When you have a strong financial buffer, that stress reduces significantly. You think more clearly. You act more confidently. You take calculated risks without fear. This is not just about money. It is about mental stability. And mental stability leads to better financial outcomes. At this point, you should recognize something important. Saving is not separate from financial growth. It is the foundation of it. Without saving, you cannot invest effectively. Without saving, you cannot handle risk. Without saving, you remain vulnerable. If you are still here, still focused, still absorbing this, then you are operating at a level most people never reach. stay with this process. And if you have not subscribed yet, this is your reminder. Because what comes next will connect saving with wealth multiplication in a way that most people completely miss. Now let's address a strategic concept. Opportunity readiness. When you have savings, you are ready to act when opportunities appear. Whether it is an investment, a business idea, or a career move, you have the resources to respond. Without savings, opportunities become missed chances. This is a hidden advantage. Preparation creates opportunity. Now imagine two individuals again. One has no savings and lives month to month. The other has a structured saving system and a strong emergency fund. When a financial opportunity appears, only one of them can act. Over time, this creates a massive difference in outcomes, not because of luck, because of preparation. Now, let's bring everything together. Saving is not optional. It is a core component of financial management. It protects you, stabilizes you, and prepares you for growth. It requires discipline, consistency, and clear boundaries. It demands that you think long-term in a short-term world, and most importantly, it gives you control. Chapter 5. Saving protects you. Investing transforms you. There is a clear line between financial safety and financial growth. Saving builds the foundation, but investing builds the structure. If you stop at saving, you remain secure but limited. If you move into investing with discipline and intelligence, you begin to expand beyond limitation. Most people fear investing because they associate it with risk, complexity, and loss. This fear is not irrational. It comes from lack of understanding. When you do not know how something works, it appears dangerous. But once you understand the principles, investing becomes structured, calculated, and controlled. The first truth you must accept is this: not investing is also a risk. When your money sits idle, inflation slowly reduces its value. What you can buy today with a certain amount will cost more in the future. If your money is not growing, it is losing power. Investing is how you counter this. It is how you ensure that your money does not remain static while the world moves forward. Now understand this clearly. Investing is not gambling. Gambling is based on chance, emotion, and impulse. Investing is based on analysis, patience, and strategy. If you approach investing without knowledge, it becomes gambling. If you approach it with structure, it becomes a wealth-building system. At this point, you need to shift your mindset again. Money should not only come from your effort, it should also come from your decisions. If this concept is starting to connect, stay focused, because this is where financial growth becomes real. And if you want to master investing step by step without confusion, make sure you are subscribed, because the next insights will change how you see money forever. Now let's break down the core principle that drives investing. Compounding. Compounding is the process where your returns start generating their own returns. It is slow in the beginning, almost invisible. But over time, it accelerates in a way that feels exponential. This is why time is critical. The earlier you start investing, the more powerful compounding becomes. Most people delay investing because they think they need large amounts of money. This is a mistake. The size of your initial investment matters less than your consistency and time horizon. Small amounts, invested regularly, can grow into significant wealth if given enough time. Now, let's move into structure. There are multiple asset classes where you can invest. Each has its own characteristics, risks, and returns. Equities represent ownership in businesses. When you invest in stocks, you are essentially buying a portion of a company. If the company grows, your investment grows. If it declines, your investment is affected. Real estate involves investing in physical property. It can generate income through rent and appreciate over time. It requires higher capital, but offers stability in many cases. Fixed income investments, such as bonds, provide regular returns with lower risk compared to equities. They are useful for stability but may not generate high growth. Then there are alternative investments, including digital assets and emerging markets, which can offer high returns but come with higher risk. The key is not to choose one blindly. The key is diversification. Diversification means spreading your investments across different assets to reduce risk. If one investment performs poorly, others can balance the impact. This is not about avoiding loss completely. It is about managing it intelligently. Now, here is where most beginners make mistakes. They chase trends. They invest based on hype, news, or social influence. This leads to poor decisions because they enter at the wrong time and exit under pressure. You must avoid this. Investing requires patience and independent thinking. Before you invest in anything, ask yourself 3 questions. Do I understand how this works? What is the risk involved? What is my time horizon? If you cannot answer these clearly, you are not ready to invest in that asset. Now, let's talk about strategy. A simple and effective approach for beginners is systematic investing. This means investing a fixed amount regularly, regardless of market conditions. This strategy reduces the impact of volatility because you buy at different price levels over time. It removes the need to time the market, and timing the market is one of the hardest things to do consistently. Consistency beats timing. Another critical concept is risk tolerance. Every individual has a different capacity to handle risk. Some can tolerate market fluctuations without panic. Others react emotionally to small losses. You must understand your own tolerance. If you take more risk than you can handle, you will make poor decisions under pressure. If you take too little risk, your growth will be limited. Balance is essential. Now let's address a powerful but often ignored factor: behavior. Your behavior in the market determines your results more than the market itself. When prices fall, fear increases. When prices rise, greed increases. If you follow emotions, you will buy high and sell low. If you follow strategy, you will remain consistent. This is why discipline is more important than intelligence in investing. Now consider this. Many people enter investing with excitement, but they lack a long-term perspective. They expect quick returns. When they do not see immediate results, they lose interest or panic. This is where they fail. Investing is not a short-term activity. It is a long-term commitment. The real rewards come to those who stay invested through cycles, who remain consistent, and who trust the process. If you are still here, still focused, then you are developing something rare: financial patience. And if this is helping you think differently, take a moment to subscribe, because the next part will connect investing with real wealth-building strategies that most people never fully understand. Now, let's go deeper into execution. You must track your investments. Not obsessively, but strategically. Monitor performance, understand trends, and evaluate whether your portfolio aligns with your goals. If adjustments are needed, make them based on logic, not emotion. Another important concept is reinvestment. When you earn returns, do not rush to spend them. Reinvest them. This accelerates compounding and increases your long-term growth. This is how wealth builds quietly. Now, let's address a misconception. High returns do not always mean better investments. Higher returns usually come with higher risk. You must evaluate whether the risk is justified. A stable, consistent return over time is often more powerful than unpredictable high gains. Now think about this. Your goal is not to get rich quickly. Your goal is to become financially independent sustainably. Quick gains can disappear. Sustainable growth builds lasting wealth. Now, let's bring everything together. Investing is the bridge between income and wealth. It requires knowledge, discipline, patience, and strategy. It demands that you think long-term while acting consistently in the short term. It rewards those who stay focused and punishes those who chase shortcuts. And most importantly, it allows your money to work for you.